Hi, everybody. Today's Facts in 5 video is called Death and Taxes. So we've all heard that famous Benjamin Franklin quote, the only thing that's certain in life is death and taxes. So how does that apply in an estate planning context? Will your estate have to owe any taxes? Will your beneficiaries have to pay any taxes? So we're going to answer a lot of those simple questions today. So the first question, will your estate have to owe any taxes? So in Connecticut and at the federal government level, there is an estate tax. So when you pass away, there's the potential that there's a Connecticut estate tax and a federal estate tax that may be due. This isn't a tax that if there is a tax due, it is paid at the estate level. So this is nothing that comes out of the pocket of your beneficiaries. It would be paid out of your estate prior to any distributions being made to your beneficiaries. And the good news is that for most people, there's not going to be an estate tax due because you have to own a certain amount of assets before the estate tax is going to apply. So there's a number that is set by both Connecticut and the federal government. It's called the estate tax exemption. If your assets exceed the amount of the estate tax exemption, that's when there's a tax due. And that estate tax exemption in 2023 is $12.92 million. And that's per person. So for married couples, you can have almost $26 million worth of assets before you should be worried about having any type of estate taxes be due upon your passing. So is there an estate tax that exists? Yes, but it's unlikely for most individuals that there is going to be a tax due when they pass away. So how about your beneficiaries? Well, the good news is that the rule of thumb is that inheritance is not taxable to beneficiaries. So even if you had $1 million life insurance policy that you leave to your spouse or you leave to your kids, that isn't deemed to be income that they have to report on their income tax return. So that's nothing they pay income tax on. The exception to the rule that there's no income taxes due on an inheritance is when we're talking about qualified retirement accounts. So those are the IRAs, the 401ks, the 403bs. All of those are pre-income tax dollars. So for example, with your personal 401k, during your career, you were contributing money into that account. It came right off the top of your paycheck. It was never reported as income on your personal income tax returns, and instead was just deposited into the retirement account and continued to grow and earn interest and such during the course of your career. When you retire and start pulling money out of that account, that's when you'll notice you'll get those tax forms every January, February to say you pulled money out of your retirement account. Now is the time where you have to pay the income taxes on those. So either you are going to be required to pay those income taxes during your lifetime, or if you pass away and your beneficiaries receive those accounts, now your beneficiaries are going to be required to pay taxes. At some point, somebody has to pay the taxes, or at least that's what the government says. So again, it's either going to be you during your lifetime, or for those, if any of those accounts are inherited by your beneficiaries are paying those taxes. And for your beneficiaries, if you pass away or if it's an account that's inherited after January 1st of 2020, the 10-year rule applies, which means your beneficiaries have 10 years to withdraw the full value of that account out. IRAs or 401ks, those qualified retirement accounts that were inherited prior to January 1st, 2020. So that if this is an account that you inherited several years ago, then you probably have what's known as the lifetime stretch rule. You as the beneficiary get to stretch out those distributions that you're required to take out of that account, what's called required minimum distributions, RMDs. You get to stretch those out over the course of your lifetime, which really lessens the income tax burden on you as the beneficiary. Due to the Secure Act being passed in 2020, they changed those rules. So now it is that 10-year rule that applies for any and all accounts that are inherited after January 1st, 2020. So just be mindful of that. Capital gains tax. Are your beneficiaries going to have to pay capital gains tax if they sell any assets that they've inherited? The good news is, again, that the answer is probably no, because when a beneficiary receives an asset through inheritance, they get what's called stepped up basis. And I have another video on our channel that really goes into what basis is in more detail, but suffice to say, and in the simplest terms, basis is what you paid for something. So if you buy stock for $100, you sell it for $1,000, you have a gain on $900 worth of appreciation. That's what you pay taxes on. So that's how basis works. So in an inheritance standpoint, an inherited asset gets stepped up basis, which means regardless of what the deceased person's basis was in that asset, The beneficiary's basis becomes this fair market value as of that asset, as of the date of the decedent's date of death. So to use a piece of real estate as an example, you inherit your parents' home. Your parents bought that property years and years ago for $100,000. It's now worth $300,000. You as the beneficiary, because when your parents passed away, or the second of your parents passed away, the fair market value of that house was $300,000. If you as the beneficiary then sell that house for $300,000, there's no gain to report because what you sold it for is the same as your basis. However, if you decide to hold on to your parents' house for a year or two and the property values appreciate, your basis is still the fair market value as of date of death. So if when your parents passed, it was $300,000, 2 years later, you sell it for $350,000. There is now some gain you might have to pay taxes on, but it's less gain than, again, just taking over your parents' basis. So it's not like you're selling it with your parents' basis of $100,000. So there's a lot more gain to pay taxes on. A lot of all that appreciation that occurred while the decedents owned that property is kind of wiped away. That's how stepped up basis works. Be mindful of the fact that there's a lot of my clients who, to make things easier because they love their kids or they just want to try to avoid assets passing through probate, gift assets during their lifetime. And not that that's bad. That's a strategy that works maybe for a number of reasons, but just be mindful of the fact if you're gifting assets. So in that same hypothetical, mom and dad, instead of letting the kids inherit the house, they gifted the house to the kids during their lifetime and didn't retain any type of ownership interest in the house. And see my video on life estates where maybe there's some kind of interest retained, but to keep it clean, to say mom and dad retained no ownership interest in the house. They just gifted the house to the kids, and then mom and dad die. If mom and dad's basis was $100,000, the kids get carryover basis because it was a lifetime gift. So now when they sell it after mom and dad pass, they are using mom and dad's basis, and there's going to be a whole lot more gain that they're going to have to pay taxes on because that's a carryover basis situation. So that's just a really broad overview of the question of what kind of taxes, if any, are going to be due when somebody passes away. The good news is it's unlikely any type of estate taxes are going to be due. So your estate isn't paying any taxes. It's in most circumstances, your beneficiaries aren't paying any taxes just because, again, there's that general rule that says, and inheritance isn't taxable to beneficiaries, with the exception of maybe those qualified retirement accounts. And inherited assets are also going to leave your beneficiaries in a really good tax positions from a capital gain standpoint. So I hope you found this helpful. If you have other tax questions or estate planning questions, please feel free to visit any of our other videos, and we look forward to seeing you with our future videos.